Welcome to this episode number 124 of Your Next Trade, called today Earnings Fools. So like always, we have many things to discuss. We had the Chinese Trump deal on Thursday that was announced, and that was pre-announced on Sunday, that was pre-announced 3 months ago and 6 months ago. So, and we had the earnings season as well. So tons of companies coming with their earnings. We had as well the end of the month. So let's start with the earnings season with a good example with the chart of Apple. So here, as you can see, this is on the left-hand side, the Apple price over the last 3 years, where the stock was roughly trading around 130, 140 US dollar. That was at the start of March 2023. And since then, the stock has been making new highs. Most recently, it has been breaking higher the 260 level and clearly going into much higher into the 277 at the open on Friday. Why? Because the earnings were really good? No, actually the earnings were just in line. And if you look at what have been the expectations over the last 3 years, so this is the blue line, and this is for the revenues. So the revenues in 2023, at the start of 2023, the market was expecting roughly 108 billion for this quarter in terms of sales. And guess what? They only managed to do 102.5 billion. So roughly 4 to 5% below the expectation 3 years versus 3 years ago. But in the meantime, the stock really doubled. And you can go through tons of stocks, probably not Nvidia, because Nvidia and some of the semiconductors have been doing pretty well and actually upgrading their numbers. But for most of the markets, what has been happening for the US is actually the expectations are not much higher than they were 2 or 3 years ago. And Apple here is a very good example. This is mostly because we do have like multiple expansion. So instead of for example, for Apple to be trading into 22 times earnings, now they are trading above 32 times. So really huge multiple expansion. And as we're going to see later, and actually this market is very much driven by very few names. And this is why the market breadth is so bad. So let's start with the week to date asset performance, starting with the Nasdaq and the S&P. So Nasdaq, pretty strong, 2.2%, because the big tech that we flagged last weekend, looking at the fabulous 7, has been breaking higher. But the most important one is obviously Japan, up 6% for the week. Why? Because we get this new government, and this government is going to be putting a lot of fiscal stimulus into play. That explains as well why the Japanese yen is weakening and weakening versus the USD. It's around $154. So literally, this is, if you look at the Nikkei, as we're going to be looking later, if you look at the technical, it's making new highs. It's parabolic. Crypto down on the week. Most of the hard assets as well has been struggling. We flagged 10 days ago the gold. That looked pretty much like a top. So what about the week to date industry performance? This is really interesting. This is and that explained a lot how the market breadth and how the winners versus the losers are doing in the US. So this is for the S&P. So this is where you have the S&P. So as you can see, very few winners. So this is the green, where you do have like tons of losers. So this is the same as before. The market is driven by semiconductors, is driven by anything that is tech, Nasdaq, technology, and on the other end of the spectrum, actually anything that is non-tech has been struggling. The most important one is retail. So really bad week for XRT, down roughly 4 to 5%. And we had many comments from companies that were not really bullish. So anything that is middle class and lower class in the US has been struggling. And there are many signals that since the start of September, actually, the US consumer has been struggling. But overall, the picture is telling you the same. Market is driven by very few names. And that means we do have like signals like that we had this week, that it's probably topish in terms of going higher. So what about the sector's performance? This is the same. Okay, technology up 2.4%, consumer discretionary with a bit of Tesla. But other than that, anything has been coming down. We are talking materials, we are talking real estate, Consumer staples as well, 3.6%. So why? Because the earnings of most of those names were not that great. So what about the rates? Looking at the US 10 years. So this is, we close at 408 on the US 10 years. So as you can see on the week, we are up 8 bips. So we went from 4% to 40.8%, despite the FOMC cutting by 25 bips. Why? Because the Fed meeting, during the Fed meeting, it was pretty hawkish, meaning that the FOMC expectations going forward are not as clear as they were 2 or 3 weeks ago, when the market was expecting, 25 bips cut at the next meeting in December. Now the market, as we can see here in the Fed funds expectation, is roughly expecting 60 to 65% chance of a cut during the next meeting. So less accommodative expectations from the Fed. Why? Because we're still having some inflation in the system. The downside is, as well as the government is shut these days in the US, we can't have the numbers to rely and to do inflation expectations. So what about the VIX? Looking at volatility. Looking at volatility, 17.5% for the VIX, and that was interesting because the market as well was trading nicely on Thursday and Friday, but in the meantime volatility was going higher. So again, due to this market breadth and the fact that many of the retail traders are buying calls, you can see higher volatility both into the 30 days and the 9 days. So I want to go quickly into the technical analysis, and what I want to do, because we are at the start of a new month and we just ended the month of October, is looking at those charts on a monthly picture. So if I start with the S&P futures, the candle is still pretty okay, but actually if you are doing the same on the weekly, it's not a great candle. So I could see the next 2 weeks being a bit of a struggle for the S&P. Nasdaq made new highs. Picture is still okay technically. The trend is still your friend if we manage to do it. So you see so far pretty good. If you look at the Russell 2000, so if we're looking at the small and mid caps, this is not as good. That tells you that the market so far has not been broadening. So you get tons of people from JP Morgan and some other place telling you, oh, don't worry, the market is going to be broadening. But so far, again, if you look at the S&P, if you look at the Nasdaq, most of their exposure, of their weightings, 30 to 50% is around 6 to 7 names. But really, those names are making new highs and pushing the market. So there is a bit of a fallacy in this price action, because most of the stocks, if you look at this week, has been done on the week despite the market being higher. CL1, so we are in the low 60s. That one is a tricky one because you still want Trump administration to be putting the prices lower. I'm not sure what to do. I wanted to put a position in XLE because I thought that XLE actually was a bit too high versus CL1, but so far it has been holding pretty well. I don't want to be taking any position yet. But that's really something that I'm monitoring. Looking at gold, so massive move since we break the 2600. That was a few months ago. This one, as you can see, this is not a good candle. You see the rejection from the 4400 almost, and we close at 4000 roughly. But that's not, at least in the short term, a good signal. Euro dollar, because we want to go into currencies, and we get the monthly, not much of a trend most recently, but a bit of a something that I should have mentioned, a bit of strengthening of the US dollar this week, and that's the same with the dollar yen. So dollar yen is a bit special because obviously the new administration in Japan would like pretty much to be weakening the Japanese yen, and this is what is happening. There's a good chance that we might go lower for the Japanese yen. Finally, I want to be talking about the Philadelphia Semiconductors. This is some serious chart. We were at 5,000 in July, and we are 7,000 now. So we are talking 40% in 5 months. So that's a massive move, and really that tells you how this market again is very much driven by very few names. Here we are talking the Fabulous 7, and again, those 30-50% of the weighting of the indexes are making the big chunk. Finally, looking a bit of the crypto world with the Bitcoin, and actually has been struggling versus the other ones. So if you think about any asset classes, crypto has been pretty dead. The different candles that you have here, it's rejection after rejection. So I won't be surprised to see crypto going lower in the next few weeks. So what about this week? What did we have starting with the S&P future? So that was on Monday here, where as always, we do have like some nice headlines over the weekend saying we're going to have a Chinese deal and everything is going to be fine. And for the whole week, we mostly trading, let's say almost sideways around 6,900, 6,950. And we close at 6,870 on the week. But more or less, the push, the pump was done over the weekend. You had the gap, and we closed at the level of the gap roughly. So that was for the Chinese deal. We had as well the big tech earnings. So we got Microsoft didn't act very, very well on the day. The most important one was probably Meta, which was down more than 10% on the day. Why? Because it's the same story as we had some years ago with Metaverse, but instead of being Metaverse, we are talking AI, where all those big tech are pushing their capex, their capital expenditure for 2026 higher, meaning now the market is really putting anything that is free cash flow lower. And if you put money at work, this is good, but that means as well that your margins are going to be struggling in the short term. So Meta really weak on the day, and weak as well on Friday. There was a follow-up. Apple was flattish on the day of the earnings. Amazon, on the contrary, was really, really strong. So, but overall, from the Meta, from this Fabulous 7, pretty good picture. Meta putting on the side. But I think what is important, as we've been talking about the earnings over the last 3 to 4 weeks, is looking at this week, which was the most important one, where we had roughly 30 to 40% of the S&P 500 companies that released their earnings. 83% are still beating the expectations. But this one is important because this is the last one. This is this one up, if I manage to do it up. Here you see this one. So we have been coming down quite a lot in terms of the magnitude of the companies by how much they are beating expectation. Last week, if you remember, we were talking more than 7% beat from the expectations from those S&P 500 companies, whereas as of now, we are talking 5.3%. This is still good, but way, way below what we had a week ago. So this week has not been great in terms of magnitude of the beats. And this is confirmed as well from most of the retail companies here. I just took the price actions of companies from hotels and food products. And as you can see, if you look at Chipotle, if you look at Royal Caribbeans, some of those names are really, really struggling. Why? Because the comments were pretty bad, saying, since the start of September, some part of retail, some part of the US consumer has been struggling. And that was the same picture that we had from one of the Fed members saying, we are seeing a K-shaped, to speed economy, meaning people that are on the top end are doing pretty well, but anything that is below has been struggling. And really, this is the picture where you had a strong divergence between the rich people, let's say, and the ones that are middle or low class. So we did have, as I said, earnings season with the consumer coming under pressure. As I said, we had a bad market breadth for several days, where actually I think it was on Tuesday, where the market was up 0.5 to 1%, and in the meantime, more than 2/3 of the companies of the stocks were down on the day. So if we look at the catalyst going forward, we're still going to have the earnings season. And as you can see, there are tons of names that are going to be releasing their earnings. We do have like some macro with the ISM manufacturing on Monday and ISM services on Wednesday. For the NFPs on Fridays, forget about it because the government is still shut in the US. Maybe at one stage it's going to be impacting retail, is going to be impacting the US consumer. So have a look at this. We do have like a very good seasonality. You probably know it in November and December. So I took here for the last 29 years of the S&P. On average, November is probably the best month at 2.6% and 0.9% in December. But I see signals of both on the market breadth, the US consumer, that are telling me a bit something different. So in the meantime, we do have like the S&P weekly straddle, which is telling us we're going to be moving by 1.44%. And finally, we're going to have as well on Tuesday, Australia rate decision, and then on Thursday, the Bank of England rate decision and some Fed speakers overall. So earnings season, government shutdown, seasonality, ISM manufacturing and services, a bit of job report with the ADP and the JOLTS opening. And other than that, this is probably that. So any questions, you can send me an email at Greg@Dupont Trading. If you want to book the mentoring for 2026, because it's coming, you should be quick if we are talking about Q1, because there are not that many spaces available for the Q1. It's only in 2 months' time. So send me an email. If you want to have access to the 4x4 video series, you can access and subscribe on the website. And if you want to go as well on the Discord community and subscribe to 30 channels, this is the link that you have here. This is it for me for this week. Have a good trading week. Bye-bye.